$50,000 HSA withdrawal feels like a $10,000 penalty until the IRS adds income tax, then adds the net investment income tax on top. In the next 9 minutes, the Tax Shield research team will show you the exact IRS code sections that stack 3 simultaneous taxes on non-qualified HSA withdrawals, the real dollar cost on a single $50,000 withdrawal, and the one form your advisor never mentions. And at minute 7, I'll show you the specific line on IRS Form 8960 that triggers the net investment income tax, even if you have W-2 wages. The detail that transforms a $10,000 penalty into a $36,000 tax bill. Let's start with the belief almost every high-income professional holds right now. Your financial advisor told you HSA withdrawals for non-medical expenses cost 20% penalty plus income tax. That's the standard talking point. It's also incomplete, and the incompleteness costs people $15,000 to $26,000 per withdrawal that could have been avoided with better understanding. The 20% penalty is real. It's codified in IRC Section 4980G, but the IRS doesn't stop there. Here's what research into Treasury Regulation Section 1411-1 and IRS Publication 969 reveals. A non-qualified HSA withdrawal triggers 3 separate taxes at the same time. First, ordinary income tax at your marginal rate. In 2024, the 37% marginal tax bracket starts at $191,950 for single filers and $243,725 for married filing jointly. If you're a high-income professional, a physician, attorney, executive, or entrepreneur, your withdrawal is taxed at 24%, 32%, 35%, or 37%, depending on your total income for the year. Second, the 20% penalty under IRC Section 4980G. That's explicit. $50,000 withdrawal, $10,000 penalty, no nuance. But third, and this is where advisors go silent, the net investment income tax under IRC Section 1411, documented in Treasury Regulation Section 1411-1 through Section 1411-10, and clarified in IRS Notice 2013-49. If your modified adjusted gross income exceeds $250,000 married filing jointly or $200,000 single, the HSA withdrawal is treated as unearned income subject to an additional 8% tax. Let's put real numbers on this. Imagine a household earning $350,000 annually, married professionals with combined W-2 income. They've built an HSA balance to $80,000 over 7 years. A family emergency arises. A child needs orthodontia, a parent needs elder care support, a business faces a gap. They need $50,000 liquid and fast. They withdraw from the HSA. Their advisor says, okay, 20% penalty, so $10,000 plus you'll owe income tax on the $50,000. Sounds manageable, maybe $25,000 total. But here's the calculation the research reveals. At $350,000 household income, this couple is in the 37% marginal federal tax bracket. The $50,000 withdrawal is taxed at 37%, $18,500 in federal income tax. Add the $10,000 penalty under IRC Section 4980G. That's $28,500 so far. But they are also $100,000 above the $250,000 MAGI threshold that triggers the net investment income tax. Per Treasury Reg Section 1411-1, non-qualified HSA withdrawals are classified as unearned income subject to the 8% NIIT. That adds $1,900. Total so far, $30,400. But we're not done. Most high-income earners also live in high-tax states: New York, California, Massachusetts, Illinois. State income tax on $50,000 at 85% California or 9% New York adds another $4,925 to $5,450. Real total, $35,325 to $35,850 on a $50,000 withdrawal. Effective tax rate, 76% to 71.7%. Your advisor quoted you $10,000. The reality is $25,000 to $35,000 more than they named. Now, why does this happen? Why is the 20% penalty the only number mentioned in most financial conversations? Research into how financial advisors market HSAs reveals a structural problem. HSA sales focus on the tax-deductible contribution and the triple tax advantage when funds are spent on qualified medical expenses. The penalty for non-qualified withdrawals is mentioned as a caveat, almost as a legal disclaimer. The compounding of 3 simultaneous tax regimes, ordinary income, the statutory penalty, and the net investment income tax, requires reading Treasury regulations and IRS notices. Most advisors, even competent ones, don't internalize this structure because their compliance training focuses on the contribution limits and qualified expense lists. The IRS Publication 969 does mention it. Look at page 10 of the current edition. If you receive a distribution from your HSA that is not used for qualified medical expenses, you must include the amount of the distribution in your gross income. Additionally, you are subject to an additional tax of 20% of the amount of the distribution. What Publication 969 doesn't emphasize, that including in gross income at high brackets, combined with the 20% penalty, combined with NIIT triggering under Section 1411, creates a cascading tax event. Here's where the research gets sharper. IRS Form 8960, Net Investment Income Tax, is the document that makes this visible. When you file your tax return after a non-qualified HSA withdrawal, your CPA or tax software will ask, do you have net investment income? Most high earners think investment income means dividends, capital gains, rental income. What Form 8960 and Treasury Reg Section 1, 1411-4 actually define as net investment income includes the gross income from interest, dividends, annuities, royalties, and rents, minus the deductions properly allocable to such gross income. But Section 1, 1411-4A1I extends this. It includes other gross income as determined by the Treasury. IRS Notice 2013-49 clarified that non-qualified HSA withdrawals fall into that category. Why? Because once the $50,000 leaves the HSA for non-medical purposes, it's no longer protected by Section 223 exclusion from income. It becomes unearned income for purposes of the NIIT. So a high-income W-2 earner, someone with pure employment income, no investment portfolio, suddenly has $50,000 in net investment income for a single tax year. If they're married filing jointly earning $350,000, their MAGI is $350,000. The NIIT applies to the lesser of 1 net investment income or 2, the excess of MAGI over $250,000. In this case, the excess is $100,000, so the NIIT applies to the full $50,000 withdrawal at 8%. That's $900 in additional federal tax that most advisors never mention. Now, let's look at the accelerating risk. Right now, in 2024, data from the Employee Benefit Research Institute and Census Bureau shows HSA adoption among high-income households earning $100,000 plus has grown 31% since 2021. Peak deductible health plans paired with HSAs are increasingly available through employer health benefits and the individual market. Many high earners view the HSA as a superior version of a flexible spending account, a way to put pre-tax dollars into an account and access them tax-free for medical expenses. What's changed? Marketing language around HSAs as retirement accounts or emergency funds has expanded. Some financial advisors pitch HSAs as part of a diversified tax shelter strategy alongside 401(k)s and IRAs. That framing is incomplete. A 401(k) has a 10% penalty on early withdrawal. An IRA has a 10% penalty, but both have a single penalty layer. The HSA has 2 penalty layers, the 20% statutory penalty plus the NIIT for high earners, making it a less liquid reserve than advisors typically imply. The stakes: a household with $100,000 in an HSA, assuming they might tap it for non-medical expenses in the future, could face a $35,000 to $45,000 tax bill on a $50,000 withdrawal if they are in the 37% bracket and subject to NIIT. That's not a $10,000 surprise. It's a $25,000 to $35,000 surprise that could push their household into an unexpected AMT, alternative minimum tax, calculation or force them to accelerate other income strategies to offset the tax hit. So what should you do right now? First, if you have an HSA balance and you're above the MAGI threshold for NIIT, $250,000 MFJ, treat it as a true medical reserve, not an emergency fund. The effective tax rate on non-qualified withdrawals is too high to justify casual access. Second, calculate your real HSA withdrawal cost before you touch the account. Take your withdrawal amount, multiply it by your marginal federal tax rate, use the 2024 bracket tables, add 20%, then add 8% if you're above the NIIT threshold. Add state income tax. That total is your real cost. Third, explore qualified medical expenses more broadly than you might think. IRS Publication 502 defines qualified medical expenses to include not just doctor visits and prescriptions, but dental, vision, hearing aids, and long-term care insurance premiums. If you need $50,000 for a family medical event, surgery recovery, ongoing treatments, equipment, you may be able to spend it from the HSA on a qualified basis without triggering the triple tax. Fourth, if you must withdraw for non-medical reasons, consider timing. If you have a low-income year, a sabbatical, a business transition, retirement, withdrawing then puts you in a lower marginal bracket and may exempt you from NIIT altogether. Planning matters more than spontaneity here. The tax code rewards those who study it. Most advisors know HSAs exist. Fewer understand the compound tax structure that activates when you break the qualified expense rule. That knowledge gap is where your $35,000 mistake lies. If you want the full numbers and the implementation checklist, the deep version is in the companion book, HSA.